Bringing you the latest in tax credit news, this is Tax Credit Tuesday with your host, Michael Novogradac.
Hello, I'm Michael Novogradac, and this is Tax Credit Tuesday. This is the May 9th, 2023 podcast. In this week's episode, we're going to discuss the benefits and hurdles of small business loan funds in the new markets tax credit space. This topic is of particular interest to community development entities, lenders, borrowers, qualified low-income community business owners, and other participants in the new markets tax credit incentive. Now, for background, the Community Development Financial Institutions Fund administers the new markets tax credit. The goal of this tax incentive is to spark community development and economic growth through the use of tax credits to attract private investment to distressed communities. Within that broader goal, the Community Development Financial Institutions Fund, or CDFI fund for short, seeks to ensure that a fair share of the new market tax credit allocation is used for small businesses. Now, a key player in the investment structure of new markets tax credits is the Community Development Entity, or CDE. CDEs are designated intermediaries that apply for and compete for new markets tax credit allocation authority. Individual and corporate investors can make equity investments in CDEs in exchange for new markets tax credits, which investors use to reduce their federal income tax liability. Now, the CDFI incentivizes CDEs to make loans to small businesses through the point scoring system that they use in awarding new market tax credits to CDEs. In today's episode, we're going to discuss why community development entities would use a small business loan fund strategy, and perhaps more importantly, what are some of the advantages or obstacles in doing so? Helping me with that discussion is Greg Clements. He's a partner of mine based in Novogradac's Dover, Ohio office. Greg works with clients in historic tax credits and renewable energy tax credits and the Opportunity Zones incentive. But most importantly for today's discussion, Greg is one of our experts on new markets tax credits. Greg works with community development entities, lenders, borrowers, investors, and other participants in the new markets tax credit space. And he also works with small business loan funds. Now, we have a lot to cover on this topic today. So if you're ready, let's get started. Greg, welcome back to Tax Credit Tuesday.
Thanks, Mike. It's great to be back. Really appreciate the opportunity.
No, it's always good to have you on the show. So I wanted to start the discussion by explaining to our listeners just exactly how the CDFI fund does incentivize community development entities to commit to use a portion of the new market tax credit award to make small business loans. So if you could explain that to our listeners, that'd be great.
Yeah, sure. The CDFI fund uses their scoring in the new market tax credit application to incentivize certain investments. And one of those is innovative investments. There's a list of innovative investments in question 19 of the application. And the CDFI fund does say that there's no one activity preferred over another of this list. But the applicant needs to identify the percentage of total calickies that will be used for each of the types of innovative investments. And if the CDE does receive an award, it may be required to meet that percentage identified in their allocation agreement. So it's important for CDEs to have a good strategy about what they select. CDEs where the total amount provided to a caligby is equal to or below $4 million is one of the options for a CDE to choose to participate in investing in innovative investments. Some of the other innovative investments from last round were investing in unrelated CDEs that don't have a new market tax credit allocation, investing in underserved states, making calickies with an original term of less than or equal to 60 months. And another example is providing calickies to non-real estate activities. So the question around innovative investments isn't scored in phase 1 of the application review process. So the response is not used to determine whether the applicant scored high enough to receive consideration for an allocation. It instead is scored in phase 2 of the review process and is one of the responses in the application that affects the size of the allocation award. It gives the CDEs an opportunity to potentially increase their award size by answering those questions correctly or to the best of their ability, and as long as it lines up with all their strategy. The last data I saw um, said that just under half of all Quiliquis met the definition of a small Quiliqui. So that's interesting, and I think that the CDFI fund and incentivizing that is probably doing what it needs to do.
Right. And I assume that when you mention half, that's half by number of loans or investments,
Yes,
not by dollar volume.
exactly, exactly. It would be difficult to get half the other way. Right?
Yes, it would be. Yes, it would be. And you mentioned the term Quiliqui and Quiliqbi. And one
Yeah,
of the aspects of any area where you get more precise expertise is you have to learn what all the acronyms mean. And it kind of reminds me years ago where I wrote an article for the ABA Journal for Affordable Housing Redevelopment, and it was entitled The ABCs of CDEs, where I kind of went through a lot of the different acronyms. And we don't need to go through all of them now, but maybe you could explain to the listeners when we talk about a Quiliqui, what a Quiliqui is and what the acronym stands for. And also when we say a Quiliqbi or Quiliqbi, there's a lot of different ways of pronouncing Quiliqbi, what a Quiliqbi is.
yeah. So a Quiliqui is a qualified low-income community investment, and a Quiliqbi is a qualified active low-income community business. So if you think about it in normal non-new market terms, a Quiliqui is the loan or the equity investment, and the Quiliqbi is the borrower or investee.
Great. Thank you for that. And when Greg says a Quiliqui is a loan or equity investment, he's referencing that you can make either a loan to a qualified active loan community investment or a Quiliqbi or an equity investment in the Quiliqbi. But for purposes of this podcast, we're dealing with loans. So when we're thinking of Quiliquis here, it's in the context of making loans to small businesses that are Quiliqbis. So Greg, broadly speaking, CDEs that commit to making small dollar loans or small business loans, they can satisfy that commitment, broadly speaking, in one of two ways. Either they can make a series of one-off small business loans, or they can form a small business loan fund that in turn makes a series of small business loans. Obviously, the podcast today is about the small business loan fund, but maybe you could explain to our listeners the distinction between these two general approaches.
Sure. So on the one-off loan, as we kind of talked about earlier, to qualify for this treatment of small Quiliquis, the Quiliqui has to be $4 million or less. And so you could think of the one-off loans as um, a traditional new market tax credit structure where you have a AB loan coming in. The leveraged lender source is ultimately underwriting and financing the borrower, the business itself. Um, and you would have a traditional closing, one sub CDE, one investment fund, one leverage lender, one tax credit investor, and they just do it with smaller dollars, 4 million or less. Um, and you're done with that. So the Small Business Loan Fund, as you said, is a group of Quiliquis that would come out of uh, a sub CDE. So you would have a difference in timing. Your QEI would close probably first, and your sub CDE may or may not know what businesses it's going to finance ultimately. So changes the dynamic a little bit on the leverage loan source because the leverage lender needs to understand that they're financing a future portfolio of Quiliquis instead of financing a specific business. So we'll talk about it later, but there are some considerations that you need to think about how that changes the dynamic and the timing.
Great. Thank you for that. We have a quick follow-up just with respect to the acronyms to our listeners. When Greg mentioned QEI, a QEI is a qualified equity investment. And that's basically the investor puts equity, into the CDE or into an entity that puts equity into the CDE. and that's what they generate the tax credits on. So QEI is the qualified equity investment that you're generating tax credits on. And obviously that's the money that the CDE uses to make their loans. And then Greg, when he talks about kind of a leverage lender, normally funds are structured in a way that an investor puts a certain amount of capital into an intervening entity. That intervening entity gets a loan from some debt source that in turn makes an investment in the CDE that in turn makes the loans. And I think one of the key distinctions that Greg's pointing out here is that you do sort of individual one-off small business loans. You have to create that structure or some version of that structure for each loan you make. And each loan has a separate leverage lender and the like, which can generate a reasonable level of complexity. And a small business fund is basically taking one leverage lender and using that leverage lender source for all of the small business loans that you're making. So maybe you could explain some of the benefits of the loan fund rather than making a series of one-off loans. Obviously, I pointed out one feature, the singular leverage lender as opposed to a series of leverage lenders.
Yeah. So one of the benefits of a loan fund rather than a series of loans is that you can control closing costs a little bit more efficiently. Quiliques vary in size depending on the needs of the Quiliques, the borrowers. But the transaction cost of a series of loans really doesn't change because you have to, all the industry participants for this transaction are going to have their own professional team. And so the closing costs really don't change, whether you're funding a $500,000 Quilique or whether you're funding a $10 million Quilique. So if you are doing a series of loans in their own sub CDEs, your transaction costs can ramp up pretty quickly. But if you choose to organize your small business or your small loan fund as a fund instead of a series of loans, you can effectively amortize that cost across more Quiliques. Another advantage to having a loan fund, depending on your strategy, is the potential for investing the same QEI dollars in multiple Quiliques, and thereby potentially increasing your community impact by recycling the money more frequently. That's achieved by having shorter term loans instead of having a 7-year loan or a loan that exceeds the term of the compliance period. There are I have worked on some loan funds that the goal is to effectively set it and forget it and have Quilique loan terms that exceed the compliance period. But I also have some clients who prefer to have a revolving door for their QEI proceeds. And whenever you do that, there are some compliance considerations that you have to consider. But I think we'll talk about that in a moment.
Okay, thank you for that. And when I think of small business loan funds, I think of sort of two versions. Why don't we start by you explaining the two types, and then we can go into them in more detail. And the two types being short-term revolver loan funds and longer-term lockouts.
Sure. So the short-term revolver, those loan terms vary by CDE and depending on their plan, but the overall plan is to recycle the QEI proceeds into multiple different borrowers. These are real loans that need to be repaid, and really the benefit to the borrower is below market interest rates. The key concern for CDEs is substantially all maintenance at their allocation agreement required percentages. And something that is key to understand for the short-term revolvers is that the CDEs need to always maintain a pipeline of potential investments to ensure compliance. Not all borrowers will want to keep the debt for the entire term, even if it is a 2 to 3 year term. So communicating with your borrowers and knowing the repayment plan of the borrower is pretty important, because that will influence how quickly and how many times you actually recycle those QEI dollars. Um, Another concern with revolvers is the redemption safe harbor. Uh, and this is the rule that says you can't redeem qualified equity investments before the compliance period is over. Um, and that's important to understand and manage because you have various types of payments on these short-term revolvers. A lot of these revolving loans either have amortization schedules for repayment of the debt or balloon payments. And the way in which the calculation, um, you need to understand what is principal and what is interest to make sure that you properly um, distribute cash flow upstream in the structure. Um, Also, another thing about the revolving funds is the CD is going to have to determine liquidity status more, because it's investing in more borrowers. And having the CDU team understand the liquidity status rules is pretty important. That will vet out any potential trip points earlier on. The more team members that you have understand the liquidity status rules. So it's easier to invest in Quiligbys when the location of the assets, revenue, and employees are known and predictable and don't move outside the qualified census tract. Um, some examples of Quiligbys in loan funds that I've seen that are short-term revolvers are small retail, light manufacturing, restaurants, nursing homes, and medical centers, and even some outdoor recreational facilities. And I've even seen some churches. So that's kind of interesting. Some difficult types of businesses that don't control where their assets employees go or where the revenue is generated, that are potential trip points or home health care, trash services, landscaping services, and excavation companies. The examples I gave of the, the assets that don't move, the revenue that doesn't really move, and the employees that stay, I've seen all of those closed before. Um, on the longer term lockout loans, um, they still have the same compliance issues and concerns, but they tend to be easier to manage because um, even if it's in a loan pool, if you have a longer term loan and it's interest only and the maturity date is beyond the compliance period, your compliance concerns are much easier and it's more predictable. You know what your interest rate is, or you know what your interest is, you know what your income is going to be. And so your compliance with redemption safe harbor is pretty easy. And because you close the loan once and it doesn't repay during the compliance period, your substantial all test is pretty easy to maintain as well.
Would you agree that the sort of central difference in the short-term revolver and the long-term lockouts is the short-term revolver, you're going to end up making a series of loans over the course of the 7-year compliance period, such as you were mentioning, you have more collectee status determinations you have to make, as well as you have to ensure that as you're getting cash in and out of the entity, you have to monitor what portion of that is generating income that can be distributed versus what portion of it is return capital that needs to be reinvested as a revolving loan fund. Whereas long-term lockouts is you're making a series of loans to small businesses, but they're for 7 years, maybe 6 years, but generally 7 years or beyond, such that you're not going to be getting principal repayments. So you pretty much have interest income coming in, and it makes it a little bit easier to do the calculation to determine how much of the cash can be distributed.
Yeah, yeah, I think so. The goal of the short term revolver is to have the QEI dollars touch as many businesses as possible. And the goal on a longer term lockout, it kind of feels like the traditional standalone series of loans that you would have closing in a large QEI and maybe even a large Quilicky, but there may be 4 or 5 of them just bundled in one sub CD.
And that's an important point that you made on the short-term revolvers, and that you end up impacting more businesses as a consequence, can potentially generate much greater community impact.
Mhm. It is a lot more impact. You have a lot more good stories to tell.
Yes.
Um, but there is more management of it. So there's more reporting, there's more maintenance of the sub-all and of tracking your redemption safe harbor.
So looking at short-term revolver funds for a moment, is there anything else you'd want to focus on with short-term revolver funds that you want to share with the listeners?
Um, so a loan fund that makes loans that are shorter term and redeploys the money a few times, um, I think it's good to know that you have to maintain compliance, right? Um, and you're going to have repayments on those loans that will need redeployed. So this requires, that the CDE compliance team diligently track the sub-all test. This isn't like a every 6 month type of activity. This is a monthly activity that you're going to have to manage. Um, it requires that the loan servicing team be required to communicate with the compliance team to the extent that they're different on upcoming principal payments, which in turn requires the compliance team to maintain projections of the repayments and communicate with the redeployment requirements to the team that sources the pipeline for new Quiligbys so that the entire organization, the CDE, can maintain proper compliance with the sub-all test. Um, so it's probably pretty good to have an internal document that multiple people have access to so that it can always see like whether you have to source a new Quiliky or not. But becomes interesting that um, if you don't get a principal repayment, you may not have funds available to make your Quiliky. So you may be communicating with potential borrowers constantly, but you may not always have a great idea of when you're going to have the capital to deploy into that business that you're courting that's in your pipeline.
A lot of what we've talked about up until you mentioned the pipeline or emphasized the pipeline are matters that might take a little bit more effort, but they're within the control of the CDE. It's within their control to do the calculations and determine how much income we distribute in the rest. And there's more work, but it's within their control. The one area that's not entirely within their control is if any loan gets repaid during the 7-year period, or at least within 6 years, they need to reinvest the money within a designated period of time. So they have to constantly be maintaining that pipeline of a potential small business borrowers so that when they get the repayment, they can make the loan, which is obviously challenging because as you pointed out, you don't know if the loan's going to get repaid or when for certain. So you can't necessarily make a commitment to the borrower, but you need to be keeping that pipeline going and you need to have some degree of depth in the pipeline.
Right. Yeah.
By the time it comes time to make the loan, you may at that point in time, the borrower may not need it, or they may not be able to underwrite appropriately, or they might lose their qualified active loan community business status. There's a number of issues on that side. So at some level, from a pure risk management perspective, that's the area that gets a lot of attention from your leverage lender and your equity investor for the tax credits because they're the ones that have the greatest potential risk of loss if that doesn't get handled appropriately. Let's turn now to the 7-year lockout small business loan funds. What are some of the pros and cons, additional pros and cons you might want to emphasize with respect to these 7-year lockout funds? Maybe you can even explain specifically why we refer to this lockout.
Yeah. So the 7-year lockout fund, like we said earlier, the portfolio of Quilikies is not going to change during the compliance period. Once your Quilikies have been closed on and you identified your borrowers, you made the loans to the borrowers, they're structured so that that's your portfolio and it's not going to change until after the compliance period's over. They're easier to manage because the duration of the Quiliky is longer than the compliance period, and and the terms normally don't change. Um, Now you could have situations where the borrowers run into a little bit of financial trouble, and you have to deal with that and deal with some workout. But that's with any loan in this industry. Um, but once the Quickies are deployed, the terms generally don't change. Um, and sub-CDE compliance is predictable, it's static. It's a little bit of set it and forget it.
And maybe you can explain to the listeners why it's called 7-year lockout fund as opposed to just a 7-year term fund.
Sure. Yeah, the lockout is really that um, those loans are going to be the loans that are in the CDE for the entire compliance period, and it doesn't change.
And there are prepayment penalties if they were.
Yeah, normally there are. Yeah, you're right. I forgot to mention that there are prepayment penalties, just like in a traditional new market tax credit structure.
Right.
There are prepayment penalties whereby the revolver, it's really designed to be recycled money. And so in that scenario, you don't have prepayment penalties.
And that's when I think of the lockout term. I think the lockout is sort of saying you're locked out of prepaying the loan. And obviously you can't completely lock somebody out because they're going to pay you back the money. It's just a question of, is there a penalty associated with the prepayment? So Greg, I think we've had a good discussion so far about the types of small business loan funds and some of the benefits of using them. But I was thinking, as opposed to when I say using them, as opposed to making one-off small business loans using the funds, maybe you could take a moment to explain to our listeners or summarize for our listeners and maybe a set place, of course, this podcast, the key benefits of using the small business loan fund as opposed to making one-off small business loans.
Yeah, so CDE applicants have an opportunity to impact the size of their award through participating in an innovative investment section of the application. And if the CDFI fund likes your plan and your track record for this type of product, you may be awarded more allocation than you otherwise would have. There's potential. Another one is there's potential for higher community impacts per dollar of QEI invested because the funds get deployed in many different businesses. Because the Quickies are smaller and have shorter term for repayment. Also, because the Quickies are smaller, the allocation gets to be used and serves a population of borrowers that are not traditionally served and are not really able to participate in receiving the benefits of a new market tax credit program um, due to the size of the Quickie. So it opens up more borrowers and more folks to use the new market tax credit program. And if the CDE has success with small loan funds, there is potential for the CDE to create a new business line to create stability of the CDE for when a CDE doesn't receive an award in a given year. So this is some of the benefits I see.
So thank you for that summary. And then if I'm talking about benefits, I have to talk about challenges. So we talked about some of the challenges of small business loan funds. Maybe you can amplify some of the earlier points or layer in a few additional ones.
Sure. So the application of a small business loan fund can be tough if you've never done one before. So you need to think about your strategy, how you're going to manage it, and seek professional guidance when you identify weak points in your strategy. High transaction costs are normal for upfront, but eventually they get shared by many different borrowers ultimately. So it may be difficult upfront to find leverage source and work through the leverage lender's underwriting requirements to make sure that the investment guidelines of the Quickies are well documented. But you need to do that at the QEI closing. For the leveraged loan, many times these need to be, I see these as variable interest rate loans based on the underlying portfolio of the ultimate Quickies. So it kind of changes depending on what you're lending money at the CDE. But if you have a situation, I've seen this, that you have a fixed interest rate for the leverage loan, normally they're going to demand guarantees of the CDE or their affiliates and demand debt reserves above the CDE and below the leverage lender to support debt service of the leverage loan during the initial deployment phase of the sub CDE or in the event of a lull in the redeployment of QEI dollars. So the revolver funds, they require more management because of the compliance considerations, sub-all and redemption safe harbor. And as I mentioned briefly, the sub-all percentage is probably going to be north of 85%. And it's important to note that in the event that you dip below 85% ever, the redeployment on the funds are required to go back up to the percentage of sub-all that is in your allocation agreement. So that could get exciting if you're in a situation where you dip below 85% and you have to find all of a sudden instead of 2 new loans, you have to find 5. So that could get exciting and something to keep on everyone's radar. It may be difficult to identify pipeline projects when there's a deadline to redeploy. So that, again, we talked about all the teams communicating in your CDE. That's really important. And the CDEs have to be diligent in their loan underwriting from a credit perspective because the CDE is counting on being fully repaid.
So thank you for that summary of some of the challenges, along with obviously earlier the advantages. One of the benefits that I like about small business loan funds is you're able to structure them as evergreen funds. And when I say evergreen funds, I mean that after the 7-year new market tax credit compliance period expires, the funds can continue to make small business loans indefinitely. So maybe you can explain to listeners how small business loan funds can be structured as evergreen funds.
Sure. So what a loan fund allows the community development entity to do is go from a path of trying to get a larger reward into developing a new line of business by leveraging the new market tax credit benefit into, as you say, evergreen funds. Many CDs will set up these funds as hope or expectation to be operating beyond the 7-year window. So how that happens is plan normally is to use the benefit of the new market tax credit subsidy to continue its investment strategy beyond the compliance period, in that the CDE is really receiving the net tax credit equity after the compliance period and using that capital when it gets repaid to make loans that are Quillicky-like investments. And each CDE is going to have a different strategy around that. The goal is to continue the work that the CDE started with the loan fund and have investments and create community impacts for as long as that capital lasts. And that's why I said that it's important to try to make sure that you underwrite the loans in a way that ensures that you get back the money that you borrowed.
That's a good explanation. The way I always sort of think about it is the new market tax credit provides the seed equity capital in a sense. And let me just say, I'm talking now in overall generalizations here. But conceptually, the new market tax credit is providing the seed equity, and then you end up getting a leveraged loan for a percentage as well. And then basically that leverage loan interest gets distributed over a broader base such that with the seed equity and the leverage loan proceeds, the CDE can make below market loans to small businesses. And then basically as they're repaying the loan, kind of conceptually, they're repaying a portion of the leverage loan and they're repaying a portion of the equity, which then can be redeployed with, additional leverage loan proceeds, additional equity. And that can just kind of go on indefinitely, subject to loan losses. Because if you end up with loan losses, the equity absorbs the loan loss, not the leverage lender. So to your point about having the loan getting repaid is obviously sort of critical, but it's also designed to be investing in riskier business and the rest. So theoretically, in due course, a leveraged loan fund might burn itself off, but it can go, a very long period of time in that evergreen way. And I would just note that there are other times when the new market tax credit equity burns off over the 7-year period, which ends up providing additional subsidy and lower interest rates to the borrowers, but also means the fund is an evergreen at the end of 7 years. A lot embedded in what I just said there. And Greg, you don't need to comment on it, but for the listeners, if you have more questions about what I just said there, please reach out to Greg. And to that end, about reaching out to Greg, Greg, if you could share with our listeners some of the resources that Novogradac offers to help clients navigate questions they have about small business loan funds.
Yeah, sure. Obviously, our main resource available is our team and our staff, um, myself included. So some of the services that we can provide are during the QE closing, we can provide forecasting and consulting services. And after the qualified equity investment is closed, we can prepare tax returns, we can perform audits, we can provide CDE compliance agreed upon procedures and Quiligby status agreed upon procedures. In addition, we can provide consulting around compliance and also reporting with the CDFI fund. Another great resource we have available is our website, um, noco.com. So there are a lot of resources available there. A lot of articles are posted there in addition to, you know, all the CDFI fund guidance that's been published over the years. It's in a very organized way. Um, Another resources we have is, an opportunity to attend the Novogradac 2023 Spring New Market Tax Credit Conference. It's going to be at the Fairmont, Washington, D.C. hotel, June 8th and 9th.
Great. Thank you for that, Greg. And will they be able to meet you there?
Yes, I'll be there. And we'll have plenty of other Novogradac team members there as well. So, and they'd all be very excited to meet each and every one of you.
I'd also note we do also have a new market tax credit working group, and it will be having a meeting in DC as well. And if you're interested in learning more about joining our new markets tax credit working group, please reach out to Greg or just send an email to cpas@novoco.com. So let me say thank you, Greg. I will include your contact information in today's show notes so listeners can reach out to you with specific questions. And to our listeners, as I say most weeks, if you have any questions or other suggestions for topics that you would think we should cover in an upcoming Tax Credit Tuesday episode, please email them to me at cpas@novoco.com. Now, I'm pleased to turn to our off-mic section where I get to ask our guests for some off-topic recommendations and words of wisdom. And I have 2 questions for you today, Greg, and I don't think I've asked them of you before in your prior visits to the podcast. And I'll start with one that's somewhat Novogradac, or at least professional service related. What's the best professional advice you've ever received?
I think this is one of my favorites. I think it's important to view every person you meet as a door that may lead you to a new opportunity. You never know how others in your network can impact your career or how you may be able to link folks in your network to provide opportunities for others. And this is something I talk to our new recruits and even some students at universities that impressing on them the importance of building out a network and keeping tabs on it.
No, I agree with that. You never have too large a network. And, you never can treat other people well enough. So it's always good to be reaching out to other people and sharing your thoughts and, assisting them in building out their networks and your networks, and everyone wins. So with our Spring Renewable Energy Tax Credit Conference coming up next week in San Diego, and as well as the New Market Tax Credit Conference next month, as you mentioned, in Washington, D.C., travel tips are something that comes to my mind. What's a travel share with our listeners?
Well, an immediate one is if you haven't booked your travel arrangements for DC, you should probably do that soon. It's on my list of things to do as well. But outside of that, I've got a young family, and so scheduling time to speak with them, either FaceTime or video conference, um, to stay in touch and act as if you're not really traveling is pretty important to keep things on the as they should be going. So I find that is important.
So, Greg, that might be the best travel tip I've ever heard on this podcast. I ask the question a lot, but to address it in a way of keeping that work-life balance and making sure that when you're traveling, you're setting aside time to keep the home fires burning with a significant other and your children and the like is probably the number one travel tip that everyone should bear in mind. So thank you for that. And I'll also say to our listeners, thank you for listening. I'm Mike Novogradac. I'll talk to you next week.
This weekly podcast has been brought to you by Novogradac & Company, LLP. Archived podcasts are available online at www.novoco.com/podcast or by subscribing to the Tax Credit Tuesday podcast in iTunes. You can find related links referenced in this podcast in our show notes at www.novoco.com/podcast. Novogradac & Company, LLP is a national certified public accounting and consulting firm with offices nationwide. Learn more about our professional services at www.novoco.com.